We'd like to talk about a case study that has unfolded within the GVF portfolio over the last few years and which continues to be an ongoing investment with an end date before 30th of June 2023. As a reference point, we are filming this case study in November 2022. What's a bit different about this example is the fact that this trade didn't quite go to plan. And it's the not going to plan part that is most interesting and hopefully highlights how the team managing GVF think about investing and managing the portfolio. Now, you may or may not have heard of Trian, the manager in this example. But Trian is a multi-billion-dollar alternative investment management fund based in New York. One of its three founders is a well-known and highly regarded billionaire activist, Nelson Peltz. If tabloid gossip is more your thing, Nelson Peltz's daughter, Nicola, recently married one of the Beckham boys. Anyway, back to the trade. Nelson Peltz has been a very successful investor over many years. He has proved very good at finding operating companies where he thinks he can run things better, engage with them, and turn things around. You may have seen him on boards such as Wendy's, Procter & Gamble, Mondelez, or most recently, Unilever. So when he looked at launching a UK company with the sole purpose of UK investors co-investing with him in a single target company, you can probably imagine that there were large UK institutional investors who were attracted to an opportunity to tap into the skill set of legendary investor Nelson Peltz. In September 2018, Trian Investors 1 Limited was brought to the UK market. The idea, as the name suggests, was that the company would be the first of many companies that Peltz would set up in the UK to accommodate individual turnaround stories. After Trian 1, investors would receive back their capital and they'd have the choice of whether to go again with Trian Investors 2, Trian Investors 3, 4, and so on. It should be said that late 2018 was a pretty tough time to IPO any company. The Federal Reserve was raising rates, equity markets were volatile, and when push came to shove, the launch of Trian Investors 1 was harder than expected. In fact, one of the investment bankers leading the IPO, Jefferies, ended up supporting the deal by purchasing a 12.7% stake at IPO to get the trade over the line. Trian's founders also invested quite a bit in the IPO, and we understand friends and family also helped Peltz get it over the line. By June 2019, Nelson and his team had chosen their target investment, Ferguson, a leading distributor of plumbing, ventilation, air conditioning, etc. across North America. Mark, perhaps you can tell us your thoughts about Ferguson and this first choice from Nelson.
Yeah, so to us, Ferguson made a lot of sense, and their thesis, which Trian laid out in a presentation not long after they built their position, seemed really sensible. I'd say the only surprising thing about the investment really was that Nelson Peltz & Co. got exactly what they wanted without having to actually join the board there. We can never know how much engagement there was behind the scenes, but to the outsider, it seemed like Nelson Peltz and Trian were pushing on an open door with Ferguson, with the company seemingly coming out and doing all the things the manager had talked about. So there's no doubt about it as well that the investment has done very well. Just to put some numbers on it, the peak for the Ferguson share price, the Ferguson investment was up 160% in sterling terms over 2.5 years. And it's obviously given up some of that this year, but even today, the investment is up around about 100% over 3 and a bit years.
Wow, and there's a graph there in front of us illustrating how well that company has done. So the underlying trade in Ferguson works out really well in hindsight. That's great. But investors in the UK didn't buy Ferguson direct. Rather, they purchased the UK company Trian Investors 1, whose underlying investment was Ferguson. It is this company that the case study is about, as Trian Investors 1 is what GVF invested into at a discount. With the benefit of hindsight, we can look at this investment of GVF's in 3 phases. To be clear, we never intended this investment to turn into a 3-phase trade, and that is what makes the story interesting. Okay, so let's begin. Phase 1. Mark, correct me if I'm wrong, but yourself, Miles, and the team started looking at Trian Investors 1 in late 2020. Tell us why you were attracted to the trade and maybe let us know the outcomes you were targeting.
Yeah, so as you pointed out, while Ferguson had done well, investors didn't own that. They owned Trian Investors 1, and returns on that were nothing like this. And so a wide discount had developed. We'd been following Trian Investors 1 for some time, but first invested in late 2020, early 2021. And that was at a high 20s discount to our estimate of the asset backing. As you alluded to earlier, this fund was quite unusual in that it intended to go after one company and return capital afterwards. And the prospectus set out rules that said, at the very least, the fund would have to return the net profits of the Ferguson trade when it sold, or potentially, we thought 100% of the capital would be returned after Ferguson had played out. So while the timing of any catalyst was uncertain, there was a hard catalyst in place. And even assuming that they reinvested the initial capital after selling Ferguson, the net profits that we'd be getting back were at that time around 40% of the price we paid. And we'd be getting this back at asset backing, which was significantly above the market price. So we modelled several scenarios, but across those, we were estimating an average mid to high teens annualized return when we invested. And what's more, the underlying portfolio was extremely transparent, one stock, and hedgeable if we wanted.
Okay, so this was a classic trading position for us with a clear catalyst in place. The trade was understated, bread and butter business that we really like, correct?
Yeah.
But it didn't go quietly or understated at all.
No, unfortunately not.
Indeed. In May 2021, out of the blue, the board of the company came out with proposals that would renege on the key IPO prospectus promises, like investing into one company at a time and returning investors' money at the end of the trade. The new proposed investment policy also gave the manager huge latitude to invest into whatever they wanted with no limits, and they didn't have to return capital at all. Mark, perhaps you could talk to us about how you guys felt when this announcement from the board was made and what your initial emergency steps were.
I mean, we were horrified, to be honest, and very quick to let the board know how we felt. We also reached out to some of the other shareholders who it turned out were just as unhappy as we were. I have to say, we often speak to other shareholders in the investments we have, and it's rare to find such a consensus as this. Literally nobody wanted these changes. On the face of it, then, you'd think the proposal stood no chance of being approved. However, as you've mentioned before, both the manager and Jefferies, the company's investment banker, both owned large stakes from the IPO. So we feared this was going to be a very close vote, with independent shareholders on one side and the manager and the company's advisor on the other. But despite the fact that we and other shareholders urged the board not to allow a situation where the change was narrowly voted through by 1% or 2%, it fell on deaf ears, and the vote got passed 52 to 48. There was also a large percentage that abstained, which I think any other board would have seen as a protest vote. Now, 52 to 48 sounds close, but if you stripped out the votes that came from the manager and Jefferies, it wasn't close at all. It was 71 to 29 in our favour. This was clearly a change that shareholders opposed, being forced upon them by shareholders that didn't have the same economic interest. What was really particularly disappointing at this time was the board and manager's attitude after the vote. The chairman of Trian Investors 1 brushed off shareholders' complaints, arguing that we needed to respect the will of the majority. The manager likened the result to an election where we'd lost and needed to accept the result and move on. We felt the board was completely captured by the manager and was putting the manager's interests above all others. Almost 3/4 of the company's independent shareholders didn't want to be there, but the board and manager weren't willing to do anything about it. All that said, it wasn't clear to us how far shareholders would be willing to fight this, or rather, how far their compliance and legal departments would let them go with this.
God, what an impossible position to be in. I mean, a captured board, a narrowly passed vote, a manager taking a Trump-like done deal approach, and a disparate and possibly despondent group of shareholders, handcuffed by perceived compliance and legal risks. Yet you guys decided to keep going. All very admirable, but how did you decide between cutting your losses, which I know you astutely do when necessary, and continuing on with something that could end up sucking a lot of time and effort?
That's a good question. Look, from a risk management perspective, the thesis had changed, and you just couldn't deny that. Even if you thought the proposals might be narrowly voted down, our perception of the manager and the board had changed dramatically for the worse. We therefore felt we had to realign the position size within the GVF portfolio, taking into account the risk reward under the new terms. One of the advantages GVF has is its size and our ability to be fairly nimble. We were in a position where we could take the position down to a size that we felt comfortable with far easier than others on the register. Before the vote, we sold some of our investment into the company's share buyback at a circa 21 discount to asset backing. And that was quite a bit better than the level that we'd entered the trade. In discount capture terms, our returns would have been roughly 14% or so had we chosen to exit entirely there. However, the returns on the trade were actually much better because of how well the underlying Ferguson investment had done. It was around 60%. We partially hedged GVF's exposure to Ferguson, so we got something between those two. But we didn't sell the entire investment there. We got it to a level that reflected the expected upside and our estimate of the probability of success. Now, you're right to ask about the time that gets taken up in campaigns like this. And as you know, Emma, this campaign took a huge amount of time and effort from you, Miles, myself, and the rest of the team. The thing is, you just don't know in advance how great that's going to be. Also, the actions of the board and the manager, we felt were just so egregious that we felt we had to stand up for ourselves and other shareholders and for just basic principles of good corporate governance.
I hear you. I mean, on the time and effort angle, you can never know, as you say. That said, I mean, for me, the experience that myself, the team, yourself have gained from this trade has been invaluable. And I really do believe that it will tangibly build on the IP that we have, the intellectual property that we have within the business. Okay, so you resize the GVF position to the risk. Your motivations are clear. And let's be honest, that point you made about corporate governance is important. There's often so much hot air about all these corporate governance initiatives that firms are making, but we see little action. Here is a real life example where the corporate governance is atrocious. And instead of just walking away, which we could have done easily, we take up the task of rallying people around to stand up. And so begins phase 2 of the trade.
Yeah, and it was months of blood, sweat and tears, and nothing was easy about this case, starting even with getting a law firm to represent us. As you know, we spoke to 8 firms trying to find someone to help, but they all had conflicts or potential conflicts. Fortunately, in the end, we found a great lawyer that was conflict-free. Then it's about going around and speaking to all the other shareholders and coming to a decision on what to do. While activism is something we're very willing to do, for other investors, it's the last thing they want to get involved in. I think all shareholders wanted to give the board a chance to do the right thing and find a solution, and just different people had different processes to follow before they felt they'd exhausted all other options. Unfortunately, it was just clear to us that this board wasn't going to look after independent shareholders' interests, so we were going to have to take action. And we've been speaking to shareholders one-on-one for several months, but we first got everybody together in a room in late 2021 to talk as a group. I'm fast forwarding a bit through a lot of work that was done by all the shareholders involved, together with legal advisors, communications advisors. But eventually we got to a stage where shareholders formed what was called an ad hoc committee. We agreed a course of action, and together we requisitioned a meeting to remove all but one director, and that included the chairman, appoint an independent candidate, and to appoint Miles as a shareholder representative. But that's just where the hard work started, as by that stage the manager owned close to 30% of the company, much more than it did at the time of the 2021 AGM. A lot of that increase came from where it bought a large stake from another shareholder in late 2021. So together with Jefferies, it now owned around 43% of the company. So every vote was vital, and therefore the press releases we as a group published had to try and appeal to the shareholder we didn't know and hadn't spoken to yet. Now, to cut a long story short, the vote was a partial victory. The chairman was removed, and the independent candidate we put forward was appointed, but the votes to remove the 2 other directors and to appoint Miles were lost by the tiniest of margins. Now, we did a lot of work on this in the days that followed to figure out why this was, and without going into too many details, we felt fairly confident that if the vote had been called again, something I think we were willing to do, we would have succeeded in removing the directors and adding Miles. As it turned out, though, this wasn't needed. Soon afterwards, And I think they did this with the knowledge that we would have won the vote eventually. The board, which by then, of course, had a different chair and it had the independent candidate we put forward, announced that it had reached a deal with the manager to distribute at least 95% of the company's assets before June 2023, and then wind up the remaining assets of the company.
Wow, wow, what a result. God, I'm not sure I've ever been so chuffed, nor Miles. But how about you, Mark?
Oh, yeah, absolutely chuffed. And it was a great outcome, even better than we could have hoped, but one that, in our view, wouldn't have happened without the updated board and the fact that the independent shareholders had the votes to ultimately win.
Yeah, absolutely. I completely agree. Okay, so now while most of the shareholders were still celebrating, we saw a third phase of this trade. Tell me about phase 3 and why this turned back into that bread and butter type trading we love.
Yeah, so once the news came out that the fund would be distributing all its assets before next year and then winding down, it became a very different type of opportunity. It's more like a simple trade where you're locking in a 10 to 12 discount that you're going to be taking out over between 9 and 12 months. And this is the kind of trade we quite often get involved in. Therefore, we felt very comfortable making this a much larger position. Now, because we had a very deep knowledge of the situation, we were able to take advantage of this quickly. And in the first day or two after the announcement, we picked up a couple of blocks. And at the level we added, even if this takes until June, July next year, it's an attractive teens annualized return. And that's with the market risk hedged out, which in the current environment is pretty valuable. And in a way, this opportunity, phase 3, is a bit of a bonus from the situation. The other bonus, I'd say, was the relationships that we've developed with the larger UK institutions that we worked with on this. So it was a happy ending, but only because we didn't accept this change of investment policy. I think if we and the other shareholders we worked with on this hadn't acted, investors could easily have been stuck permanently in this or forced to sell at a huge discount. Instead, shareholders are getting their money back at full value next year. I think it goes to show that sometimes activism is just self-defense and an important risk management tool.
Completely agree. Thank you, Mark. What a journey. And my goodness, what a great win for GVF and UK corporate governance.